I recently bought ServiceNow, ticker symbol NOW. And I want to explain why, because this is a perfect example of how I think about stocks and companies. When a stock falls, the question is not simply, is the chart ugly? Because most of the times it really is. The real question is, has the business changed or has the price changed? And that is exactly why ServiceNow became interesting to me. I bought ServiceNow when it was trading at around 20 times forward earnings. For a normal company, perhaps this is not super cheap, but if we look at ServiceNow valuation, then it is a completely different story because this company has historically traded at much higher valuation multiples. At different points in time, ServiceNow has traded at 50, 60, 80, even close to 100 times forward earnings, and that is quite expensive. So when a high quality software compounder falls to around 20 times forward earnings, I do pay attention. Now, the stock does look expensive if you only look at trailing price to earnings. Current data shows that ServiceNow is trading at around 70 times trailing earnings. But trailing earnings is looking backwards, the past. Forward price to earnings is looking at expected future earnings. And with a company like ServiceNow, the forward number matters more because the company is still growing. Let's look at the revenue chart. Because in 2017, ServiceNow generated almost $2 billion in revenue. But by 2025, revenue grew to almost 14 billion. That means revenue is almost 7 times higher than it was in 2017. So this is the setup. The stock price fell, valuation compressed, but the business hasn't really changed. And that is where the so-called SaaSpocalypse comes in. The SaaSpocalypse is the fear that AI agents will destroy traditional software companies. The idea is simple. If AI can do most of the work directly, then maybe companies will not need so many software companies or platforms, dashboards, seats and subscriptions. The fear hit many software companies really hard. And ServiceNow was one of the companies caught in that narrative. But I think the market may be overlooking this. Because ServiceNow is not just another software dashboard, it sits deeply inside large companies. So it connects IT workflows, HR, customer service, operations, security, approvals, tickets, automations, all sorts. In simple terms, ServiceNow is like a digital operating system for large companies. So, if AI agents are going to do the work inside companies, what do they need? And the answer is, they need permissions, they need workflows, they need data, approvals and governance. They also need integration with existing enterprise systems. And that is exactly where ServiceNow is already positioned. So, the SaaSpocalypse argument says AI will replace software, but my counter argument is AI may actually make the best workflow platforms even more valuable. Because enterprises do not just need random AI chatbots, they need controlled AI agents that can actually do work safely inside the business. And this is why ServiceNow could benefit from AI instead of being destroyed by it. Now, to be clear, this is not risk-free, nothing really is. If revenue growth slows, the stock can fall further. If AI really goes to disrupt the enterprise software faster than expected, ServiceNow's valuation could compress again. This is not a deep value stock in any way, but investing is not always about finding perfect companies with zero risk, because there is no zero risk. It is about finding situations where the market may be too pessimistic. And in my view, ServiceNow became interesting because the market was pricing a lot of fear while the company is still producing massive results. Revenue is still growing over 20% and the company is highly embedded in large enterprises. And the valuation compared to its own history became cheap. And that is why I bought the stock. I own 500 shares and I also have some options exposure. But the main point is not the trade itself for this video. The main point is the thinking process. I'm not buying ServiceNow because the stock is down. I am buying it because the business still looks strong, the valuation has compressed, and the AI fear is, in my opinion, massively overdone. So my thesis is simple. If ServiceNow keeps growing revenue at around 20%, continues to expand earnings, and proves that AI strengthens its workflow platform rather than just replacing it, then buying at around 20 times forward earnings could look very attractive over the long term. Of course, if the SaaSpocalypse thesis is right, then AI weakens the value of traditional enterprise software, and this could be a value trap. That is the debate, really. And that is what makes this stock interesting. In my opinion, ServiceNow is a guaranteed winner. I could be wrong. But at this valuation, with this revenue growth and the strategic position inside enterprise workflows, I do think that the risk-reward becomes attractive. Of course, this is not financial advice. I am simply showing how I think about a real position in my own portfolio. And namely, I think about business quality, revenue growth, valuation history, AI disruption risk, and whether the market has become too pessimistic. Because sometimes the best opportunities appear when a great company gets grouped together with a broken narrative. And right now, ServiceNow is one of those cases.